Good morning. It's Tuesday, the 14th of January, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming like always from Mumbai, India's financial capital. Our top stories and themes for today. The stock markets hit a 7-month low. Some fund managers are still wary of high valuations. Shipments of Russian oil to India are now assured as we brace for impact. Why are oil prices falling and India's unique bargaining stance? The rupee slides past 86 to the US dollar for the first time. And how to interpret consumption trends in India, particularly when data is weak.
This is the Core Report with Govindraj Ethiraj.
The markets hit a 7-month low. The stock markets fell sharply on Monday with the benchmarks and the mid and small caps indices all hitting 7-month lows. A strong United States jobs report and thus the likelihood of fewer interest rate cuts there, coupled with worries over slowing domestic earnings, were amongst the reasons driving the markets down, which admittedly were weak to start with. And thus the week began on a weak note. The 30-stock Sensex fell about 1,031 points to close at 76,347. The NSE Nifty 50 was also lower by about 345 points at 23,085. Now, the Nifty Small Cap 100 and the Nifty Midcap 100 indices were also down about 4% each. Perhaps a good thing, as analyst G. Chokalingam told us yesterday, is to focus on buying opportunities. Perhaps there's very little else you can do. But the perception of valuations is important, which can, of course, vary. Let's get a contra view in. Money Control quotes Kotak Institutional Equities Sanjeev Prasad saying the valuations for many stocks and sectors are absurd. According to the Kotak report, the run-up in the stocks is a result of the lack of fear and the focus on greed of returns amongst retail investors that have pushed valuations to absurd levels in several cases. Moreover, it says the sky-high valuations are primarily resulting from price-agnostic buying from non-institutional investors and forced buying of domestic institutional investors for the past couple of years. Forced presumably refers to the fact that there is so much money coming in which has to be deployed somewhere. And nor is Kotak expecting foreign portfolio investors to jump in a hurry or return. We have recorded or noted that they've sold $2.5 billion already in Jan. And there is no clear sign or signal on the immediate horizon that they will return, even to the core report. As a result, the recent sharp correction in the market and stocks does not change Kotak's cautious outlook on the market, as valuations, they say, remain frothy. There's also low scope for earning upgrades, they say, as a result of fairly aggressive earnings, profitability, and volume assumptions across sector. Moreover, according to them, investors were willing to give any multiple for stocks irrespective of the business models and fundamentals, use exotic valuation methodologies and multiples, and believe any random narrative about sectors and stocks, says the report, adding that it's possible that retail investors may show some of their usual chutzpah and buy stocks aggressively, which is buying on dips, but that would really be comical. To conclude, the large cap universe might hold out better, says Kotak, while small, mid, and narrative stocks could bleed, seeing further correction. Now, narrative stocks is obviously an interesting term. Kotak says that some narrative stocks have a further way to fall based on their true valuations. Many of them have corrected sharply in the past 3 to 6 months, but most are trading at absolutely ludicrous valuations. So narrative stocks is the term to remember. I can think of some sectors and stock groupings which are part of this narrative, but let me not get into that today. Inflation is down. Inflation, as predicted for December 2024, has eased off, coming down to 5.2%, lower than 5.5% that was in November. Within this, Bank of Baroda research points out that urban inflation was much lower at 4.6% compared to rural at 5.8%, as the latter has a greater weight of food or for food products. Food inflation, of course, is coming down gradually, with the winter crop easing prices now at 8.4% after hitting 9% in November and 9.5% in October. Inflation has been above 5% in the food bucket for cereals, meat, eggs, oils, fruits, and vegetables. The only good news here is the inflation rate for spices turned negative, while that of pulses was holding at about 4% or just under 4%. The rupee slides again. The Indian rupee has, as predicted, gone past 86 rupees per US dollar for the first time ever. Also on Monday, this comes after that strong US jobs report that compounded the pressure from weak inflows and higher hedging activity, according to Reuters, which also added that the rupee had declined now to a lifetime low of 86 rupees 39 paise per dollar, tracking also a weakness in Asian currencies. And this followed an overall picture of US economic resilience, which is, of course, the narrative that we've been hearing for the last couple of months. Action in the oil space. And now our energy segment, brought to you by the India Energy Week. Oil prices have now crossed $81 a barrel, the highest in 4 months, thanks to wider US sanctions on Russian oil and the expected effect on exports to top buyers, India and China. But all of this may not be bad news for India, so hold on to find out why. Brent crude futures rose almost $1.7 to $81.44 a barrel on Monday morning after hitting the highest level since August 27th at about $81.49. So crude oil prices have risen almost 7% since January 8th after new US sanctions on Russian oil, which affects 2 oil producers and some 183 ships. Goldman Sachs had estimated that these ships represented some 25% of Russian oil exports. That estimate is a little higher by some other brokerages. India is, however, not expecting any disruption to Russian oil supply in the next 2 months as US sanctioned tankers are allowed to discharge crude until March, a senior government official told Reuters on Monday. Now, the big expectation or the flip to this story, of course, is that India might actually start getting discounted crude. Sources told Reuters that Russia could offer deeper discounts for crude exports to India to meet the $60 a barrel cap to continue exports. That cap was imposed by the G7 countries in 2022 to curb Russian oil revenue used to fund the Ukraine war. Meanwhile, Bloomberg reported that 3 tankers carrying more than 2 million barrels of Russian oil were floating in waters off the eastern coast of China after they were sanctioned. So what is driving up oil prices right now, and what are the overall demand and supply trends looking like as we go into 2025? I reached out to Viktor Katona, head of oil analysis at energy research firm Kpler, now based out of Dubai, and I began by asking him why prices were rising so suddenly now before asking him about his outlook.
Well, it's definitely geopolitical risk premiums all over the place, because one could assume that when the Biden administration would leave the Oval Office, they would try to leave the Oval Office with the oil prices, going lower. Because ultimately, the supply and demand fundamentals are quite negative. But effectively, the Biden administration has started its tenure in 2021 with the oil price of 56. And it's finishing it up. I mean, we don't even know where it's going to end. It's going to be above 80, that's for sure. And initially, it all started out with Iranian sanctions and a little bit of a tightening on that end. And right now, it's a fully blown Russian story. The sanctions on Russia are by far the biggest that we have seen so far. The market is abuzz with speculation as to what might be potentially happening. And effectively, all of that just feeds into the insecurity. So it's a really interesting interplay between a very weak fundamental picture and a lot of geopolitical risk premium.
Right. And I'll come back to that risk premium in a moment. But from a pure demand and supply point of view of oil, where are we today, particularly as we stand in the second week of January?
Well, we stand in an environment where we look into 2025 and we know a couple of things. We know that we will have a tremendous amount of non-OPEC supply hitting the markets at different stages in 2025. So the market is going to be oversupplied, which will most probably force OPEC Plus to maintain the production levels that they have currently pretty much across the year. So we know that the market is going to be oversupplied, and we also know that demand is slowing down. Basically, the extent of demand slowing down is also a little bit of a reflection on how aggressive Trump could be, because it could be much worse. Right now, we've had a relatively meager, sort of lukewarm Biden attitude towards China. And even with this, China has slowed down to the extent that it basically almost doesn't have growth in diesel and gasoline. So it's basically the Chinese growth story is over. Maybe the Indian growth story could be something of a bullish momentum for oil price. But beyond that, there's nothing. We have stagnating Europe, stagnating North America. Africa could be a good story, but it always has its difficulties in growing the way that it should. So ultimately, demand growth will be below 1 million barrels per day. And pretty much this is a new reality. We are slowing down as humanity with our oil consumption. So again, demand outlook, because of this, there's more crude hitting the market. We actually need less crude into 2025, will be increasingly bearish for most of the year.
Right. And to come to the geopolitical part, the latest trigger, of course, is the increased US sanctions on Russia, which is resulting in over 180 ships being sanctioned and 2 producers as well, which in turn is affecting or likely to affect both India and China. and their imports or our imports. So why is this pushing up prices to start with?
I mean, it creates a huge layer of uncertainty whether the Russians can actually continue the exports that they have currently. I think that the exports that we see currently will be maintained, but it will come at several caveats. Freight will become significantly more expensive. Because the sanctions pressure, the Indian buyers or the Chinese buyers would ask for much better prices than they had in 2024. So basically, the discounts on Russian oil will effectively deepen. Everyone will be asking, don't give us -3 to Brent, give us -5 or give us -6. The classical game. And effectively, people and trading operations would get much, much more creative. Basically, you've seen it in late 2024. Almost every single cargo just, went from port A into the destination port B. There was no hidden operations, ship-to-ship transfers. I think we're going to see a huge recovery in everything that's hidden and wants to be hidden. Ship-to-ship operations, shutting off transponders, spoofing your signals, all of that, beautiful interplay between the sellers and the buyers and whoever the oversight is, that is going to come back again. I'm not a firm believer in this having a big impact on supply and demand balances, but it will definitely create a lot of speculation. And speculation is great for oil prices. I mean, of course, if you want them to be higher.
Okay, so for India and China, you said that both countries could be in a position to get oil at lower prices. So in which case it helps these countries because their overall oil import bill will come down. And particularly, let's say, at a time when the dollar itself is so strong, that's useful. So, I mean, which sort of comes back to the same question, which is that do you see India and China being able to command at least, let's say in India's case, more than 25% of imports at a lower price than what it was last year?
And particularly, and a very emphatic yes, considering how little have prices changed in 2024. I mean, you just look at prices of Urals. It was, Brent -$3 per barrel pretty much across the entire year. There was almost little to no change throughout the months, regardless of the seasonality. And I think now the Indian refiners finally have, a great argument to say, hey, look, dear Russian supplier, we would be potentially even keen to buy it, provided that your tanker is non-sanctioned. But you need to offer us a great price. And then ultimately, the boot is finally on the foot of the Indian buyer. They can demand a much better price, and they will. So I think it will happen. 25%, easy. Considering Russian imports have made up 45% of all of India's total seaborne imports, I think we could even be talking about much higher figures than that.
Right. And as we go into, 2025 and into February and March, if let's say demand starts slowing down, particularly for heating and so on, are there any other trends you're seeing?
Well, there's this big seasonality trend, not in India, but say in Russia or the suppliers. And particularly this moves into March and April, when you would have the first spring refinery maintenance period. India doesn't really work under the same logic that, say, the Russians or the Europeans would, because in India, mostly the refinery maintenance takes place in the monsoon period. So there's nothing happening in the spring. Spring is still a solid consumption period, not booming, but it's basically stable growth from one month into another. This means that there will be a lot of crude into a period when India needs it, but the other continents, so be that, Russia, the former Soviet Union, Europe, even North America, no longer need that much crude, which again is great because you would be awash with crude. India is still consuming. India is still a keen buyer. So effectively, I think everything is set for a much better period into the spring than the winter was, when India was buying expensive grades for quite a lot of money and couldn't really dictate its own terms. I think India could dictate its terms very soon as pretty much the key buyer.
Right, Victor, thank you so much for joining me. This segment was supported by the India Energy Week 2025, scheduled from February 11th to 14th, 2025 in New Delhi. And you can register for the same using the link in the show notes on this show. China trade surplus hits close to $1 trillion. Chinese exporters are rushing to push product out before any new tariffs kick in, barely in a week's time, if it does, after Trump's inauguration. The overall trade surplus for China was an unprecedented $992 billion in 2024, according to a statement from the Customs Administration on Monday there, quoted by Bloomberg, adding that this was about 21% higher than the previous year and driven by record exports and weak imports. Outbound shipments for the whole of last year were about $3.6 trillion. Interestingly, despite the volume going up, prices have been falling, so the value is less even as deflation inside China worsens and pushes down the cost of goods, according to Bloomberg. The result is that total export volumes rose about 7.3% through November, according to the Ministry of Transport, but that was faster than the 5.4% rise in values. We're obviously talking about China here. Understanding household consumption trends. There has been much discussion on the state of India's household consumption and what is driving it, or more specifically, where is the slowdown and who's facing it? Is the narrative, for example, being hijacked by some companies who are facing pressure while others are doing fine, particularly in consumer products and maybe more particularly those who sell direct to consumer online? The data has also been giving out conflicting signals. Rama Bijapurkar, author, business advisor, and researcher of Indian consumer markets, wrote in a column in Business Standard a few weeks ago that the last year has seen frenzied and obsessive discussions on the state of the health of Indian household consumption, with economists, stock market analysts, media marketers, all discussing it from their particular vantage points. Adding to the confusion, the available data, she says, sent conflicting signals. GST collections, that's goods and services tax, collections were up. Revenue growth of listed fast-moving consumer good companies was disappointed. Healthcare and telecom not bad. Two-wheelers not much to complain about. Second-hand sales did better than first-hand in some categories. And the divergence between the performance of companies in the same sector made average industry growth numbers meaningless. According to her, the consumption discourse needs more honest examination of the elephants in the room, like, for example, whether private sector investment is truly slow on account of poor demand. So I reached out to her and I began by asking her what drove her to write this piece and also her approach to make this consumption discussion more meaningful.
The listed company results have hijacked the discourse on consumption. The idea that there is a bellwether company in the old days, there was Infosys and there was HUL, and between the two of them, we knew exactly how the economy was doing. But I think today it isn't so anymore. And so this whole idea that because results of one FMCG listed company are doing badly, therefore consumption is bad, whereas you have so many other indicators to the contrary. I mean, as I say in my column, GST collections are up, small second-hand smartphones are doing well, two-wheelers have nothing to complain about, healthcare has grown, and also where I come from is the fact that the space for consumption has been, on the supply side, has been taken up by small companies who are now no longer the unorganized sector. They're actually lean, mean, smart companies who are giving big companies a run for their money. So, holistic look at what is happening in terms of, even if you must use sales data, a holistic look at what's happening to sales or customer spend is warranted rather than moaning and groaning about the results of one so-called bellwether company.
If you were to look at the entire, let's say, the quantum of consumption, so let's say it's 100 units sold by everyone, wouldn't the levers and Nestle's in, let's say, certain categories, for example, daily use categories, still represent a large portion of it or a chunk of it, and therefore also be symptomatic of what's going on the demand side?
Not really. I mean, I think over a period of time, as India has always had a large unorganized sector market, it's over half. In the past, we could ignore it because it was truly low quality for low price. Today, significant chunk of even everyday categories. I mean, I have, in fact, also I've just been looking. So if you look at, for example, let's say a Scotch-Brite sponge, it's 299 rupees for a packet of kitchen sponges. A Bala one is about 199. The numbers are right. Go on Amazon and look it up. One has a rating of 4.4, one has a rating of 4.1. One sells 5,000 units in the last month, according to Amazon. One sold 4,000. I go into a very small so-called supermarket in a 40,000 pop strata town in Tamil Nadu. I see both displayed next to each other. I go to Amazon. I see them displayed next to each other. And so it is true that for their categories, their price points, which is my point also about the Nestle CEO, that you're talking about UHT milk, which is expensive milk. You're talking about chocolates. You're talking about a certain kind of consumption of your portfolio. So how does the portfolio that Hindustan Lever chooses to have represent consumer spend? I also feel that there is intense intercategory competition. So therefore, people may be skimping and saving on. There was a consumer quote that I loved recently where this young lady said, और इतना डेट के लिए पूछता है या so much for a date और देता है सिर्फ Cadbury, just Cadbury. So I mean, I think I don't know what she was expecting other than just Cadbury. But cultural labels are changing. So I think we just have to change the way we look at consumption. And that's just the supply side argument.
So on the demand side, I think why people are perhaps a little apprehensive. So you're possibly right about a few companies hijacking the agenda, but I think if you look at the other indicators, one is GST numbers are more or less steady to flat and going up and down over the last year. So it's not like it's a rapid linear growth, which we thought it was. I mean, it's maybe 160,000 crores, 170,000 crores, back to 150,000 crores, and so on. So that's one. Second is GDP numbers are slowing down, and we've actually revised downwards now officially for 24-25 as well. So which suggests that the overall pie in across the spectrum is not growing and has only shrunk or relatively shrunk. So how would you look at then, or how would you place your argument?
Yes, I agree that consumption is when GDP slows down. But the point I'm making is that the discussion has to go via the root of income. So GDP is slowing down, or even at times when it is higher than we think it is, than we expected it to be. The question is, what is happening to household income? And whose household income? I mean, I think we now know that, and therefore I'm asking for a more nuanced argument, because it's not a macro force with a magic finger like a tide that lifts everybody and tanks everybody. So it is true that the top 20% continues to stay stable, continues to get richer, continues to grow its income, etc., etc. So if you look at the drivers of consumption, there is income, there is employment. And my point is that yes, there is an overall slowdown, but why are we siloizing and disconnecting the investment argument from the economic activity argument, the occupation argument, the income argument as a result of occupation, and therefore who is consuming what? And so that's another thing for me of how not to do it, is how not to siloize it. So for example, there is a conspiracy of silence around the fact, while we say 94% or whatever is informal, etc., etc., the nature of occupation is a lot of own account workers. So when economic activity is vibrant, everybody does well. When economic activity is not, everybody takes a haircut. But when I start hearing economists say that there is no investment or low investment or an investment slow because they don't see demand visibility, I have a big issue with it. If they don't see demand visibility in India in the time that it's going to take for the capacities and so on to take off, I mean, where are they going to go and see demand visibility and compete? We've already seen India and go overseas, compete, come back, etc., etc. And it's not an either or. The reason they're not investing is something else. And so I'm saying, let's call out the elephant in the room, whatever may be the elephant in the room.
So let me pick up on two more points. And you talked about household income. So one is that household income, again, yes, salaries are growing and incomes are growing, but not as fast as they were growing maybe 2 or 3 years ago. And I'm talking about right now. There are two parts to this now. One is, let's say, if incomes are growing fast enough to match inflation, which clearly people are concerned. I mean, maybe the evidence is more anecdotal here, but it is definitely, inflation is eating into consumption power. The second is the propensity to spend. Now, that is something that, so you may have the money, but you may still not spend it. And therefore, the outcome is the same. How are you seeing these two, again, when you look at how similar cycles have played out in the past?
So I would look at consumption with the question of with who, and not a question of what, not what is being bought, but who is buying. We are finding that rich India continues to buy. Everybody is saying that. So rich India continues to buy. In fact, rich India is underserved. In fact, if you've been on the Christmas break holiday, you know how hard it is to splurge it up, even if you want to, because supply is constrained. I can't get enough. There are not enough business class seats coming back from anywhere. So I think that part of it is okay. It's underserved at the moment. You are right that there is inflation. That is precisely the discussion we should have. That people say this means the middle class is in trouble. I have a problem with that, because a lot of the so-called middle class is not actually the middle class. Middle class, by definition, has to start with a reasonable surplus income of about 30%, because that's what gives stability, it gives them ability to invest back and so on. So a lot of the consumption, and if you take, let's say, 20% slabs or quintiles, a lot of the consumption, we've seen this historically, in the middle 20%, the surpluses are so fragile that the minute you have an increase on any count, those surpluses, people are forced to make intercategory choices. So they were never middle class to begin with. So the overall argument that when GDP slows down, economic activity, it means economic activity is slow, it means incomes are slow. It therefore means that there will be tough spending choices. I take that. It is tougher with the middle, who we designated as the middle class, whereas they're not. And I think the upper class is doing well. So you will find some guys singing all the way to the bank and some guys not. The same Nestle chairman in his speech said that the rich are buying like it's going out of style or something like that, he said. But the incremental consumption that you get in good times from the middle of the consumer base by way of income, upgrading to occasional indulgences is not happening.
And that is because, just to go back to where we started.
Because they have fragile surpluses, and those fragile surpluses are wiped out the minute you have inflation.
The way we should look at or define middle class is when any family has 30% surplus income left at the end of the year.
Yeah, at the end of every month. Routine expenses. I'm also saying there has to be resilience. Resilience means you fall off and you come back up. Resilience comes when you have an occupation, not when you're an on-account worker of any. When you have a profession, a calling, a pesha, right? And that tells you the quality of how you earn. So if you are wandering casual laborer in good times, you can sort of do well enough. You will see that in the occupational definitions. But if you are a plumber, a carpenter, an electrician, you have work to do. If you have some kind of a professional qualification, forget about a regular job. If you have haath mein kaam, as they call it, even if times are bad, you can bounce back. So we're looking at resilience, we're looking at surplus income, we're looking at reasonable levels of skills and education to qualify you to be able to earn a decent living, right? And that's how you get intergenerational progress. That's how you get them reinvesting in their lives. And that's what gives stability to a country and a society, a genuine middle class. So middle class is not income between X and Y, broaden X and Y, and you will keep increasing the number of middle class. We can say that when we are selling India, but I think we shouldn't smoke our own dope.
So you talked about the rich being underserved, and I think you've given some good illustrations. I could add, let's say, 5-star hotel rooms in resorts in India, or even for that matter in city, and what price we are forced to pay for it. Can one survive, or how many people could survive by only serving the rich, which is underserved in your estimation? And can markets exist like that?
You'll be surprised at how many companies do not go below serving the top 20%. I think there are a handful, as I have also been saying for a while, and in my book as well, that there is a handful. Some of the handful are again beginning to question the pain of the mass markets, because the pain of the mass markets is also small competitors. That is the issue. If you talk about the stock market, I think it is of the rich, for the rich, by the rich, of companies, barring a handful, that do not serve anybody but the rich. So if 50% of India's household income is with the rich, and we can't say K-shape on the one hand and not go through with the implications on that. I think people are saying, and to put it politely, that why should I kiss the frog when I can kiss the prince? The frog will eventually turn into a prince because I can kiss the prince. The only point is that mass markets like time and tide don't wait for you. And that's why the small businesses have actually started doing so well, because they now have access to so many of the ingredients that earlier were not available to you. You didn't have access to media, you didn't have access to markets, but now you have marketplaces, you have media, you can Insta. You look at the number of guys on Insta, they're so bloody damn good, right? So even the rich end is not safe. In fact, I was thinking yesterday that perhaps the big companies are better off serving the mass markets, because that's where they can build scale, they can build predictability, they can hold prices when it's needed. And those are the guys, that's where they might win. So on an attractiveness, competitiveness scale, I think there are real choices to be made. But yes, if you think that you are serving 50% of the GDP of the fifth largest economy in the world on track to the third, I think you can build a pretty nice business. Thank you very much. Even if you look at our total private final expenditure, and if you look at the turnovers of many of our top consumer-facing companies, there's enough room.
Right. In your column, you said that CEOs should quote economists rather than the other way around. What did you mean?
I absolutely love the Nestle CEO. I think he's a very sensible person. And I think that when I go on to conference, when I go on to webinars and so on, where there are senior economists who are quoting CEOs, I'm thinking this is not right, because this CEO is talking about is giving a press release, a conference on the 1% growth of the categories that he serves compared to what he served last year. And so when that becomes received wisdom for economists about the state of health of the economy, I think the Nestle chairman would also agree with me that it's much more comforting and reassuring if there is a de novo analysis ground up by economists, which chairmen of companies look at and decide to predict their future, rather than the other way around, because it makes me nervous.
Good note to end on. Rama, thank you so much for speaking with me.
Thank you, Govind.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.